morning, good afternoon, good evening, traders from across the globe, and welcome to the 1150th edition of Short-Term Trading Live with Oscar Carboni, and that, of course, would be me. Good evening, traders. Sunday evening, we are presenting this video to you for trading Sunday through Monday, March 24th, 2014. Before we get into this, volatility is very, very high right now. I mean, very high. It's extreme. Stops are huge. Remember that futures trading is not suitable for all trading accounts. You can lose more than just your money that's in your account in this game. You've got to use stops. You got to know a stop is your best friend. You've got to be really careful out there because these markets have been vicious. We have not seen a single day where the market goes in one direction in a while. You know, we used to get those market opens, pulls back a little, rallies up, you get out, pulls back a little, holds, rallies up, you get out. We haven't seen days like that in a while. What we get is market pulls back, runs up, makes a new high, hangs out there for a little while, smashes down, makes a new low, hangs out there for a little while, and then comes back. Very difficult, right? So, volatility is very high. What we plan on doing, we've got a red OMNI to start the day off Sunday through Monday in the emini S&P. We are getting in. If it comes down, we are getting out and we are sidestepping this market because let me tell you, this market, short term, yes, a wobble. Long term, the trend is still very, very intact. I will show you that in the chart segment. The short term is a wobble, but the long term is still very intact. We have done zero damage to the long term trend with a couple of down days. We only actually had one down day, right? Friday. Tonight's masterpiece market will be T-bonds, traders. I think you're going to love what you're about to see. Come on down to livewithoscar.com. Come join us in our free chat room. Don't trade alone. Never trade alone, traders. If you're sitting by yourself, if you're sitting in your bathroom typing on your laptop, or you're in your living room or your bedroom in your pajamas, don't try to do this alone. Come on down to livewithoscar.com. Come into a chat room where there are hundreds of us gathering together, helping each other get through these rough and tumble days, and I'm there at the helm keeping everybody focused. All right, so we're going to show charts on the bonds. I'm going to show you that the long term is intact and that the short term may give us a wobble. With no further ado, let's go look at some charts. Okay, traders, as I was saying, short term, a wobble to the downside, maybe. This is your MACD indicator, moving average convergence divergence. It is a bit of a longer term indicator, but we're day traders, so this is an indicator for a few days to come, maybe a little longer, right? So a few days up, a few days down. The Russell 2000 is deemed one of our leaders. The MACD is a very powerful indicator. We would never ever use the MACD as a standalone indicator because that's dangerous, but mixed with other indicators and chart formations and a good chart read, the MACD can tell you if you're going to continue in one direction. And it looks like we're going to get another day to the downside based on the MACD and your Russell. Another leading market is the Dow Jones Transportation Average, and it just crossed as of Friday. That's usually a sell signal. Then you've got the MACD in the NASDAQ. Traders, another one of our leaders, and this one's really gone far. So one of the leaders has really taken the MACD lower. The MACD on the ES is all the way up here. So if the follower ES is going to follow the leader, it should come down just like the NASDAQ did. Then, of course, we've got the Dow Jones Industrial Average, the big kahuna. And that, once again, you've had a crossover. It's still pointing down. You've got to watch this MACD for short-term downside. And then the emini S&P, the one that we're all looking to trade, right? The NASDAQ's got out of control. I don't know if it's Apple DAC or Google DAC or Biogen DAC, call it whatever you want. But it's gotten so volatile, it's difficult to find stops in the NASDAQ. So we'll concentrate on the emini S&P, which at least the volatility, it's not like this, it's more like this right now. You know, that's NASDAQ, that's ES. So, another MACD pointing straight down. But, traders, I'm here to tell you, don't lose your heads. Do not fall in love with the downside. Why? This goes back since the crash lows, right? This line and that line are complete parallels. You can't see the 2009 low. It's under the chart, but it is there, and this line touches it. So you are in this wonderful channel. 2008, 2009, 10, 11, 12, 13. The 2014 target is up here, but what's nice about this chart is this. We were in this channel since 2009. Getting to 2014, we get above the channel. We've had a test into it which held and looks to me like an inverted head and shoulders. So if the test held and it's an inverted head and shoulders, we're above this major resistance line. That target is certainly not out of line for the year 2014. Then there's this. Traders, the emini S&P monthly bar chart. I've been showing you this chart for quite some time since I found this wonderful pattern, and this pattern showed us that we get up here somewhere near, well, let's just call it that target. You know what the target is. I've shown that to you in my videos. It looks like it's going to come in. In fact, on this chart, this isn't my yearly target of 2130 to 2150. It's actually a little bit lower than that. On this one, the target based off of this is around the 1986 area. So once we get to there, we'll see what's going to happen. This is the yearly target. Who knows what will happen this year? This is the target based on the formations that you're seeing. So yes, we can have a bit of a wobble, but that on a monthly bar does not look bearish at all for long term. Traders, then there's the masterpiece market of the evening. Remember, I've been showing you this for quite some time. And right before Aunt Janet came out to give us her meeting last week, I said, look, we're right about to hit this red arc once again, right near the 200 bar moving average. What a great spot for her to come out and speak. And boom, we dropped to here. So far it's working. Now we are on our 33rd week below the 200 bar moving average. That does not happen in bonds, traders. It has not for many years. 33 weeks below the 200 bar. But there's more. Look at this bond. Remember this chart, traders? I showed this to you. I cannot tell you how long ago, a monthly. And I said, look at this monthly bar chart. Is this a head and shoulders forming right at the top of this major multi-year channel? And I put a question mark there. This has all filled in since. Let me blow this up for you. Very same chart. This has all filled in since. Same chart. Shoulder, head, shoulder, right at the top of that major multi-year resistance line. Comes down, now is under the average once again. Look at how many months under this average. Doesn't happen, doesn't happen, doesn't happen, doesn't happen, just for a short time. When it goes down, it comes right back up. This one is spending some time down here. So it looks like the bonds are absolutely getting ready to slowly start to erode. I don't think it'll go straight down, but certainly they look like they're willing to come off over the next few months. Traders, look at this chart. This is a wonderful, wonderful chart. This goes back since the 1990s, probably the year 1990. We have been in this channel on this chart in the bonds, and it has stayed in constantly for years and years. It hits the top, it goes to the bottom. It hits the bottom, it goes to the top, to the bottom, to the top, to the bottom, stays at the bottom, hits the top, top, bottom is expected. That takes us below 125 at some point this year in T-bonds. Traders, pull your own charts. Do your own homework. The death knell has been sent into the bond market. It is now just a matter of time. Again, nothing goes straight down or straight up, right? You get a lot of this, but down should be the path of least resistance in bonds. So traders, you've seen the charts. There's my technical argument for why we've got, sure, a short-term wobble is possible in the indices, but long-term, that trend is very intact for now. Of course, that could change, but for now, the long-term uptrend is very intact in our U.S. indices. Do not fall in love with the downside of these moves. All right. Did you like the bond charts, traders? I mean, I don't care what Yellen says. I don't care what anyone in the world says. That speaks for itself. That is what is going to happen in bonds as long as something in the world doesn't change dramatically. Those charts are leading and pointing to where bonds will go next. All right, traders. So that's about it. You've seen what I've got. Remember, we're short-term traders, as I've told you in these last few videos, because volatility is so expanded, you can't count on this arrow being down the entire day. It could easily drop, turn around, and go this way before the day is over. So that arrow's only good for the first trade. After that, I don't want to be held to nothing. Once the markets calm down a little bit, we'll start leaving arrows up for the entire day. You know what I mean? But for now, you got to play the way it wants you to play. You can't force a market to be red or green, right? We'll do whatever the market asks of us. All right, traders, I'll see you at livewithoscar.com. Don't forget, Keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, and every evening. And you know what that is. Boy, that's a long one. Ready? Stops are in. Emotions are out. Rock and roll traders, video 1150. And again, I say, do not fall in love with the downside. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.